You might ask yourself, what would a buy and hold investment in the stock market look like if it were a trading system? So in order to do that, we created a trading system, and here's what it looks like. Buy next bar at market, and if market position equals 1, sell next bar at market. So what this does is it gets, for example, it buys at the open, and then it sells the next bar at the open, but then it buys it again. And so you're just comparing each day's open to open, buy and hold. So this bar buys, it exited the previous day's trade at the open, but then it went long again at the open. And then it exited that trade at the open, but it went long again at the open. And we're doing this to analyze 90 years of data in the Dow Jones to see what it would look like in a trading system. What are the trading system results of buy and hold if it were compared to a trading system? And so here is what we have. 22,545 days in the Dow since 1927. Here is the equity curve, and you see the profit factor 1.08. You see the drawdown 77, 28, 15. So almost triple your money on this basis based on recent run-ups. You see what are the drawdowns? Well, it changes over time. At this point, the Dow is at, or the equity curve is at 13,190 back in 2000, at the end of 2007, beginning 2008, 13,000, and then it drops to these levels here. These lows are about 6,000 when it comes down to this level. So it gets cut in half at its very lowest point in this time frame, and so that's about a 50% drawdown there. You see some more 50% drawdowns back here, and so it's hard to see because it's kind of an exponential curve based on percentage returns. But you see, for example, the market is at 750 here, and then at this point it drops to 503. Actually 449 there, and it's got a high point of 749. Actually 813 there, and then you drop to 450 range in here, and so almost a 50% drawdown there. And so over time you have these 50% dips in the stock market, and so your stock market risk can be 50%, and your return over drawdown might look like 2 to 1 at certain times, but right now it looks like 3 to 1 over the long haul. But I would say at any point your risk could be 50% if you just buy and hold, or especially if you buy at an equity peak. And so that's some of the risks that you have to consider. Every trading approach has risk, and I just want to balance out what appears to be, since this time frame, almost no risk in the stock market. And so, we suffer from recency bias and think, wow, now the stock market is never going to have another big drawdown, maybe 10% or 15% drawdowns, but we're going to go forward from here, and we're not going to have to deal with these big drawdowns anymore because these have somehow been fixed by the Fed or by Wall Street. And so that is one thing you have to consider in your investments, is your recency bias and what is your risk in every asset class, alternative investment, stock market. And it's good to be able to compare the Dow Jones buy and hold statistics to a trading system. So this is the model of buy and hold, and this is what the trading system looks like with just one unit. Obviously, dollar cost averaging for long-term investors, compounding profits and dividends would yield much higher results. But when you can also take that approach as far as compounding in your trading as well. But just comparing on a one unit to one unit basis, it's not, if you were just going to trade this as one unit, I don't think anybody would be that impressed with these trading system results, especially going back 90 years. You can see the number of days that are profitable. About 52.2% of the days are profitable from open to open, and 1.08 profit factor. And so that brings a little bit of reality reality to what the Dow has to offer and what the stock market has to offer.